Hello and welcome to The Pitch, brought to you by Livewire Markets. I'm Ali Selby, and today we're joined by Kelly Marty from Nuveen Churchill to learn what's driving the revival in the deal market this year. Thanks so much for joining us today, Kelly. It's really awesome to feature you on The Pitch.
Thank you so much for having me. It's a pleasure to be here.
Over the last few years, we've really seen a slowdown in M&A. Is there any signs that that is starting to shift?
Sure, absolutely. I think it's helpful to take a step back and kind of attribute what was causing the slowdown in M&A activity. And really, when we look at an LBO transaction, it's typically a private equity firm selling their business to another private equity firm. The selling sponsor obviously wants to fetch the highest valuation possible, while the buying sponsor wants to pay what they view as a reasonable multiple, but not overpay. And so that delta between what we call the bid-ask really started to widen in the last couple of years. And there are a couple of reasons for that. One, the interest rate environment. Sponsors really weren't sure, as a buying sponsor of a business, how high interest rates were going to go and how expensive the debt was going to be that they were using to finance that acquisition, as well as the macroeconomic landscape. As you're buying a business, you want to have certainty that the business is going to perform according to your projections, and that was a little bit harder to predict given the macroeconomic climate. So really both of those kind of variables have been taken off the table. The interest rate environment is very clear. SOFR has maxed at where it is right now. There are expected to be rate cuts even as soon as this year and certainly into next year. So the interest rate environment has much more clarity. And the macroeconomic landscape, at least in the United States, has really kind of resolved into a soft landing scenario. We aren't really seeing massive headwinds from a macroeconomic environment. So with those two variables off the table, buyers and sellers are starting to find a more middle point in that bid-ask spread. So we're starting to see more transactions come to market.
Have you seen, private equity firms holding onto assets longer than they historically would? And is there any impact from that?
Definitely. So as a selling sponsor, if you're going to go to market with a particular asset and you can't get the valuation that you think is deserved, you will hold that asset longer. Typically, private equity firms are looking to buy businesses, professionalize them, give operational expertise to the management team, and then sell that business in 3 to 5 years. What's happened in this environment, because buying and selling sponsors aren't really having that meeting in the middle, selling sponsors are holding onto their businesses quite a bit longer, 5, 6, even 7 years. And we're seeing actually a new trend in the market where sponsors are selling those assets into continuation vehicles, which are also owned by the same sponsor, but allows a slight shift in ownership while still maintaining control of the business.
What does that mean for investors, that new structure?
So from an investor perspective, if you're investing with an asset manager, and that asset manager is having trouble finding deal opportunities because the LBO environment is a little bit slower, they're going to have trouble deploying capital. And that's why it's really important when you're seeking an asset manager to understand that asset manager's sourcing capabilities. So we at Churchill have a very unique sourcing capability that we're investing directly in private equity funds, and that in turn drives very consistent and robust deal flow for us. So all the deals that come to market, we are able to see, and that allows us to maintain very high selectivity for the assets that we eventually underwrite and finance.
If we are seeing this revival in the deal market, where are you seeing the most opportunity today?
Yeah, it's a great question. And really it comes down to what characteristics we like to see in our underlying borrowers. And there are several characteristics that we look for a business that we choose to finance. The first one being lack of cyclicality. It's very difficult to get comfortable with a business that's going to exhibit cyclical patterns in their revenue and cash flow. Another characteristic we like to see is strong historical financial performance. We want to see a long-term track record with that borrower, how they performed during different market environments. We like to underwrite a very strong management team, as well as sponsor ownership is very important to us as well. And finally, cash flow conversion. When we're levering these businesses, it's important to see that the cash flow characteristics of the business are able to finance the debt that we're putting on that business. We spend a lot of time assessing that. So really those are the characteristics of the types of businesses that we look for. And the types of industries that fit those characteristics are primarily business services. That's our largest industry category that we're investing in today, because those types of businesses exhibit those characteristics that I just talked about. Another industry would be healthcare. Healthcare is obviously non-cyclical. The demand drivers continue to exist despite cyclical patterns, so we tend to invest quite a bit in healthcare. Another industry I would say is software as a service. Again, these are middle market companies that we're underwriting, but we do find a lot of attractive opportunities in middle market software as a service businesses. So those are 3 primary categories of industries that we're seeking.
Where are you seeing the most risk today?
So again, it's going to be kind of based on the cash flow characteristics of the business and the cyclical patterns. So if we see a business opportunity that has distinct cyclical risk, we're definitely going to take pencils down on that because that's very difficult to get comfortable with in this environment.
Would that be like a mining company or a resources company or a financial company?
It could, certainly any of those. Anything in the industry segment is very difficult for us to ever get comfortable with, so we tend to avoid the energy sector altogether. Another area would be retail or restaurants, because what you see in those businesses is there's a very high need to spend CapEx. So specifically in restaurants and retail, really every dollar those businesses are earning, they have to redeploy that money to build new restaurants, new stores, or refurbish existing stores. So that cash flow conversion that we look for doesn't tend to exist in those types of businesses.
Okay, well, thank you so much for your time today, Kelly. It was really great to feature you on The Pitch.
Well, thank you so much for having me.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.